I'm Julian Herbert, a Vice President at Everest Group. I'm based in London, as is my colleague Ricky Sundrani. Our office is actually just around the corner in Covent Garden, so drop by if you'd care to at any point. Just a quick poll, who's heard of Everest Group? Okay, not bad, a smattering of you, that's great. So a very quick intro to Everest Group for those of you who don't know us. We've been around for a long time, 32 years. A certain evolution. We had a consulting and advisory business that we sold to a company called Wavestone 2 years ago, and we are now solely focused on research. And the research covers IT, business process and engineering services, and associated enabling technologies. We are about 500 analysts, based largely in India, but we've got a team here in the UK and some in the US. And the real, I think the value that we bring to this discussion is that we have a lot of tier one organisations use us to benchmark what they're paying for their services. And Ricky will talk a bit more about that. So the data that we've got and the data that we base our analysis on is real data. It has recency as well, and it comes from real client contracts. We don't just, of course, do pricing advisory. We do a whole range of stuff outside of that. But since that's the focus of this presentation, that's what we'll be talking about. So I'm going to be just topping. I won't even be tailing it. Just topping this presentation before handing over to Ricky. So I'm going to talk you through very quickly the first two of those things. I'm going to talk about the macroeconomy and enterprise challenges and priorities, and then that segues quite nicely, I think, into the real meat of this, which Ricky will take you through. And he'll talk you about through some genuine actions about some sort of points of advice, really, on how client organisations, buying organisations can realise savings in the current situation, whatever the current situation is. And of course, we can then have a chat at the end. If at any point you've got questions, do stick your hand up and we'll do our best to get through it. So let's begin. Try and set the scene a little bit. The reason that I've got the three-arrow thing is the usual things: fear, uncertainty, and doubt. Recession. Is there going to be a recession? Are we in a recession? The jury is kind of out. If we look at recent labour market stats, for example, OECD, pretty flat. The US actually added 500,000 jobs in January. The UK nudged up about, I think, 0.1 of a percentage point in February. But generally speaking, the labour market is pretty good. Yeah, I don't think we can poo-poo the fact that a large chunk of the population feels squeezed and feels that money is tight. But if you walk down St Martin's Lane on a Thursday night, you could be forgiven for thinking that there isn't yet a recession. So that sort of uncertainty is kind of where we are. We still have, of course, soaring inflation, and whilst the UK is now the world leader in inflation, certainly ahead of the US and the rest of the OECD, at around, what do we say, retail food inflation, it's over 17% for January. So it's not great, but so inflation is there, and inflation is there for everything, and it's there too for pricing, as we'll see in a moment. This is an interesting one, the declining loan volumes thing. There is very clearly, a decline in the amount of money being borrowed to reinvest in business. And one of the things that I do as part of my role with the information services team is look at service providers' earnings every quarter in some detail. And the one trend that I've seen this quarter very clearly is that service providers are doing two things. One is they're paying down variable interest debt. So they are releasing cash to pay down debt. And that has two effects. One, it means they can't currently invest. And two, it means that their earnings per share or dividends have also dropped. So we're in that strange sort of situation where they've got to do something to recreate shareholder value. And one of the things they're doing is using cash piles generated over the last 2 years to buy back shares. So it's a slightly strange situation where cash is being used to create shareholder value in a rather blunt way, shall we say. But the declining loans volume means that they're not borrowing to reinvest. And that rather horrible chart at the bottom with the spikes just points to the fact really that the probability of recession, if you look at one or two models that cleverer colleagues than my cleverer colleagues have put together, the probability of recession is as high as it's been since 2007-8. So we are on the brink of something, but not quite yet there. And I suppose before I hand over to Ricky for the bulk of this, the one thing that I think we try to advise or try to encourage people to do is to have control of those elements of your business that you can have control over. You can't control inflation, you can't control the labour market, you can't control most of what's going on. But what you can control, certainly one of the things you can control, is the data that you use to make decisions. And that's really important, and I think that's quite a neat segue, I think, for what Ricky's going to talk about. So we have gross uncertainty. I think we can probably say, yes, we're teetering on the edge of a recession, but gross uncertainty is where we really are. So challenges and priorities. Look, I've spelt priorities wrong. That's not great, is it? Priories. That's where monks live, isn't it? But there you go. So this is based on a key issue study that we do every year. We've run this every year for the last umpteen years, and I've just got the sort of top-level results from the last two. The key things that have swapped over or changed places are this flagging of the fact that price and cost pressure is a number one challenge, now the number one challenge. It was number 2 last year, it's number 1 this year. And that's kind of swapped places with talent. Talent, everyone was talking about talent a year ago, and talent now has dropped to position 3, and where it was 1 last year. Slowdown in demand has accelerated or jumped several places in the rankings from 10 to 4. And interestingly, this thing about slowdown in customer decision-making, it's an interesting one. So a year ago, people were saying there is a slowdown in customer decision-making. That has now dropped, believe it or not, to fifth place as a declared challenge. And I think the reason for that is it's kind of baked into people's thinking. A year ago, they were expecting it, and now it's come to pass. It's like okay, it's not that much of a challenge. So what do those challenges translate to? And what they translate to is a ranking of priorities. So what are enterprises going to do? The first thing they're going to do, of course, is optimize costs. They want to find ways to save money, to be more efficient. It's perfectly normal, and we've seen this periodically. We saw it in the first months of COVID. We saw it in 2007, 2008. It's a perfectly normal place to go to when you're teetering on the brink of recession. Digital transformation, strangely, has not really changed in terms of ranking. It's still at number 2, and that's great. And a lot of that is because long-term contracts that were for digital transformation are now underway. They're being done. So they remain priorities until they're completed. Those big strategic transformation projects are underway, and they've yet to run through. Productivity improvement perhaps goes hand in hand with optimization. It's an enabler for it, really. But there are some other things that hint at general investment, which are positive. Customer experience improvement for those businesses that are looking to swap out people for technology or to enhance people with technology. Innovation, talent and acquisition management has dropped. I think it was 2 last year and it's 6 this year. And rather surprisingly, for me anyway, given that quite a lot of what I do is look at the risk profile of service providers, is that they're saying that service delivery, resiliency and risk is now way down the list of immediate priorities. Perhaps it's something that they're doing anyway, and it's a bit of a given. So I think that sets a little bit of a scene. And I'm going to hand over to Ricky, my colleague, to introduce himself and to talk through the meat of the presentation, the pricing element.
Thank you, Julian. Hi everyone, my name is Ricky Sundrani. I'm a partner with the pricing assurance team at Everest Group. Been with Everest for about 8-9 years. Was based out of the India office, recently moved to the UK to sort of work closely on the Europe and UK market. So for the last 8 to 9 years, I've been tracking the outsourcing services pricing very closely across IT, BPO services, and that's where this sort of analysis is coming from. And I think what Julian pointed out to, that cost optimization remains the #1 priority for a lot of organizations. And we did try to sort of do some research in terms of what are some of those different levers that enterprises are actually pulling to actually meet those objectives. So we're going to talk about some of those levers that we've actually seen happen or enterprises use in real life. So what we're going to try and do is first just try and look at the overall picture in terms of how has outsourcing pricing evolved and what is our forecast for 2023. Now, when it comes to forecast, obviously there are different models evolved and there are different permutations, combinations. So what we've tried to do is we've tried to paint 2 different scenarios. Scenario 1 is really where we talk about a full-blown recession, right? And right now, if you think about it, financial analysts globally are sort of divided amongst the view in terms of will there be a proper recession or will we sort of continue to have the status quo maintained? So potential price impact, we've sort of drawn out these 2 scenarios. So scenario is really characterized by a very sharp decrease in consumer demand, increase in unemployment, and a strict freeze in hiring. Now, what we anticipate is that in spite of there being a sort of a proper recession, we still anticipate that outsourcing services pricing will go up. Now, the magnitude of this change is much, much lower compared to what we saw in 2022 because of various issues, but we still anticipate that for some of the standard IT skills, you still probably have 2 to 3% sort of price increases happening across the market. For some of the more traditional, for some of the more specialized skills, and when I say specialized skills, I'm primarily referring to something in the space of cloud, cybersecurity, DevOps, ML, and so on. Over there, we might see actually a close to 3 to 5% sort of rate increase across both offshore and onshore. When I say onshore, I'm primarily referring to some of the more consumption markets such as the UK, Europe, US, and so on. And when I'm primarily referring to offshore, I'm referring majorly to India, Philippines, which are the majority offshore-driven markets. If we move to the more plausible scenario, if you were to do between these 2, that's the where we sort of enterprises continue to have the status quo, right? And this will be characterized by sort of pockets of reduced demand. But fundamentally, what we believe is that the demand will remain sustained, and there will be, and this is characterized also by a gradual reduction in employee attrition. So discretionary spending is going to be there. It's going to be scrutinized, but it's not going to be stopped completely. So projects will continue, but of course they're going to be scrutinized more. That's probably what we believe is a more plausible scenario. Now, if you compare the price forecast that we have for scenario B, we are anticipating anywhere between 3 to sort of a 4% increase across most of the standard IT and BPO skills. Now, for specialized IT skills, going up to about 5 to 6%. If you compare and contrast again to what we saw in 2022, they were almost touching 8-9%, for specialized skills touching almost double-digit numbers. So this is probably much lesser than what we saw in 2022. And again, it's a result of lower demand, better things on the supply side. I think what Guy also pointed to, right? So the objective around talent acquisition is sort of reduced. It's a combination of both supply and demand side sort of equation getting better. So having established the fact that, of course, the prices are going to go up, outsourcing costs are going to go up. Now, we're going to talk about 4 plausible actions that we've seen some enterprises adopt and successfully pivot to. So number one is really about a very simple way of where enterprises have succeeded in terms of keeping their outsourcing spend in check by simply introducing more competitive tension, right? I'm going to talk about 2 examples or two organizations where we actually help them do this. One is a financial services organization headquartered in Europe, and they do a lot of transformation work. When I say transformation, think of things like SAP implementation or some of those platform-related work, right? What they did is they primarily used to work with some of the global vendors. Think of the likes of IBM, Accenture, and so on. Now, what they've done late last year, is they've brought in additional competition by introducing a Big Four vendor. When I say Big Four, I'm primarily referring to Deloitte, EY, KPMG, PwC of the world. They've introduced an additional vendor in the form of Big Four. That brought in two benefits. One is that, of course, there was more competition in the portfolio, which sort of kept the existing vendors in check in terms of not just their price, but also in terms of the solution, right? And we sort of have a very strong point of view around solutions, because we very strongly believe that it's not just the rate card or the absolute price that you pay impacts your outsourcing spend, but also in terms of solution, right? A very simple example of it could be my rate card could be very competitive, but if I am doing majority of my work from onshore, then it's going to blow up my business case, versus compared to another enterprise who may be paying slightly higher rates, but then majority of the work is driven from offshore because that delivery model works best for them. So even then they'll have a much better cost profile. So that's what we would refer to as solution-related mandate, solution-related bloat, right? So over here, the sort of the enterprise over here was able to realize both benefits. One is keep their vendors in check in terms of cost, and second, get access to better talent. So they also introduced some additional competitors in the form of in software engineering, one premium and one low-cost player, and multiple competitors were introduced as part of the staff augmentation service as well.
Because I think that's potentially quite an insightful point in that.
Definitely. So I'll maybe explain this with an example. So there was a large oil and gas company. They were going about doing a big, large SAP transformation, really big bang, large one. Think of $20-odd million implementation focused alone on SAP S/4HANA. And when they saw the bill, when they saw this proposal from one of the vendors, they were taken aback in terms of how expensive this whole proposition is, right? And they came to us saying that, okay, can you help us do a benchmark on this or help us review this proposal? And when we started looking at the proposal, we realized that the vendor was very smart. That what they'd done is the rate cards were pretty competitive, but if you look at the overall solution, the kind of people they had put in as part of each of the different phases. So an SAP S/4HANA implementation is typically characterized by having a blueprinting or a sort of an advisory or a consultative phase at the beginning, followed by an implementation, followed by a test and deploy. So what they'd done is they'd put in very expensive, very senior folks as part of the advisory and blueprinting phase. So what that did is blueprinting, which let's say would typically cost about 20% or 25% of the overall cost, ended up costing about 50% of the overall spend that they'd produced, right? So this was just one of the things. The other thing is that they'd put in very senior folks, right? They put in architects everywhere where you could actually do away with a mid-level engineer, right? So these were some of the solution-related bloat that they had actually put in, which caused the whole proposal to go haywire. And we actually were able to advise and benchmark and bring them down to about close to 14 or 15 million, where they actually ended up signing the deal. So that's what we really mean by solution-related bloat. The other example is, again, a Netherlands-based utilities company where, again, they exercised sort of this approach by bringing in additional vendors for their AMS and testing services. And here as well, this led to positive price correction and overall positive cost-based impact for their IT services. This time around, they actually bought into India heritage vendors. And I say India heritage, I'm primarily referring to the likes of Tata, Infosys, Wipro, and so on. They introduced those two vendors into the mix, and were able to sort of get much better cost profile. This is number one. Now, moving on, we're going to talk about some more non-rate card levers, right? So because as I kept talking about, rate card is just one of those many levers. The other levers are what we're going to talk about now. So one of the things that's been very, very, very broadly discussed last year was the whole aspect around COLA, right? So till late last year, till end of 2021, a lot of enterprises were very wary of having COLA as part of their clauses, having COLA as part of their contracts. They believe that they should not be paying for COLA, but implicitly everybody was paying for COLA because service provider, there are no free lunches, so service provider is going to bake in that risk somewhere or the other, right? Now, what has happened in 2022 is we're seeing more and more explicit COLA clauses being listed out in most outsourcing contracts. Now, what that does is basically have a more equitable risk balance between the service provider and the enterprise, right? So instead of service provider bearing all the risk associated with COLA and then putting all of that risk in as part of the proposal or the solution, let's have an equitable COLA clause between both parties, which kind of is easy to track and keeps both of them in check, right? So that's one major change. And a counter to that is sort of the FX change, right? Because if you think about it, if there's a 5% COLA increment, that might be actually counter balanced by the FX depreciation. When I say FX depreciation, a majority of a lot of outsourcing contracts now are being supported or driven from India, right? And if you look at the currency exchange movements for the local currency in India versus, let's say, something like a dollar, that Indian currency has depreciated by about 8 to 9%. Now, what that does is it provides the service provider some margin cushion. So even if the service provider may end up saying that, oh, my costs have gone up by 10%, but then the counter to that is, oh, but the FX is also depreciated. Your costs you're bearing costs in INR or the Indian currency, so the FX kind of, the FX depreciation provides you some sort of a cushion when you come to me with this COLA discussion. What we're also seeing is, I think, the last year, I think, because where we had the more traditional rate card-based outsourcing, right? What that taught a lot of enterprise and service providers is that every penny increase in wages is going to result in pain either for the enterprise or for the service provider. So now there's a lot more open perception about navigating to alternate commercial models. When I say alternate commercial models, it could be more output-based, outcome-driven models where, of course, it is more of a long-term overhaul because if you think about it, output and outcome-based models have a whole different way of adjusting or managing the risk between the service provider and the enterprise. So we're definitely seeing there's a much more open-mindedness about adopting some of these alternate commercial models. And then finally, something around joint governance, right? Because we're seeing a big shift so earlier it used to be service providers say, I'm going to commit to a 30% reduction over a 5-year deal term now, and enterprises used to accept it at face value and like, okay, let's sign this contract. But then what they've realized is that what gets committed to may or may not get realized as part of the contract now. So there's much more investment from the enterprises in terms of, okay, let's just govern this jointly. Even if you're committing to 20% to me, a 20% reduction over 5 years, let's just track how you're going to get there, right? And how you're going to get there, what are the ways to adopt to it, and how can I help, right? So there's a lot of investment from the enterprise clients as well to get invested into the relationship and find and identify ways as to how to basically hold the provider accountable for getting there. So these are some of the more fundamental changes that we're starting to see in terms of the non-rate card TCO related levers. Action number 3, right? So this is related to software license, right? And we're often asked, right, and what's the ideal term of a contract that we should agree to? And that question probably is easier said than done. And what we've also realized is that typically most enterprises, they will want to commit to something between 1 to 3 years because that gives them a lot of flexibility. They can move move between platforms and they don't have to have a lock-in for 5 or more than years. It gives them some flexibility. However, I think for some of the more standard IT platforms, you've also seen, and of course, if you commit to 1 to 3 years, the discounts that you end up getting from your vendor are much lesser. Versus if you commit to something between 5 to 10 years, the kind of discounts are almost 40 to 50% higher than what you commit to on the 1 to 3 year sort of time frame duration. So that's why what we believe the sweet spot of that is really the 3 to 5 years where you get some discounts, but also gives you flexibility. And that flexibility is honestly really important given the dynamically changing world that we're living in, right? So 3 to 5 is sort of the sweet spot where a lot of enterprises are actually agreeing to. And this sort of fits well even with their services SaaS strategy. When outsourcing services contracts, 3 to 5 years is sort of the sweet spot where most enterprises agree to. And finally, again, this is a very interesting topic in our opinion because if you think about it, clients often ask us in terms of, okay, the vendors come back to us asking for a 10% rate increase, right? And is there a right answer to it? Do we say it's absolutely wrong or that's fine to go ahead with it? So that really depends on what are you currently paying, right? Because there are some legacy contracts which have been signed at very aggressive, very low prices. In those cases, even a 10, 15, 20% reduction or increase in prices is actually acceptable because it makes way for a more equitable relationship. However, there are contracts which are all where the client is already paying closer to the 80th percentile or 70th percentile of the market prices. Then in those cases, even a 1% increase may not actually be justified, right? So what we are recommending here is that some enterprises, some mature enterprises have figured out very smart ways in terms of leveraging market data and then putting that in front of service providers to have a very well-defined negotiation strategy there, right? So rather than just denying everything, what we're seeing is that go to your service provider, ask them for, okay, I'm agreeing to X percentage of rate increase in this part of the portfolio, say for cloud and cybersecurity, I'm agreeing to a 3% or slightly higher rate increase, but for something which is more commodity, I'm not okay with the 3%, I'm actually okay with only a 1%. So have that negotiation strategy based on your service portfolio. So that's where we believe mature enterprises have leveraged external market data quite well. So, and of course, it gives a lot of comfort, right, to both the enterprise and service providers rather than just relying on hearsay. So that's the final action number 4 that I would recommend. Yeah. So very quickly, Everest Group, as Julian touched upon, we work with a lot of enterprises and service providers. On the enterprise side specifically, I am very close to what we call as pricing analytics as a service. It's sort of a membership where we offer support to enterprises on ongoing pricing conversations, helping them negotiate or helping them figure out what is the right price to pay for a particular set of service or software licenses. So very quickly, that's what we do, and that's what I do specifically. So I'll rest my case and take any questions.
Thank you very much.
Thank you.